Welcome Option Master subscribers. My name is Asad Dasani. This is Lecture 9, Implied Volatility, Part 1. So today we're going to talk about implied volatility. This is going to be over 2 lectures, so this one and the next. Implied volatility is a very important concept for options. It's one of the key things that we can use to build trading strategies around options. So understanding it is very important. So the first thing we're going to do today is we are going to first define implied volatility. And implied volatility comes from the Black-Scholes model. So we'll be drawing on what we've been doing in the last few lectures. After that, we will look at an implied volatility calculator in Excel. So I will show you how to calculate implied volatility in Excel. It's a little bit different to how we've been calculating everything else so far. So we've calculated sort of the Black-Scholes option prices. We've done the Greeks. The last thing to do is calculate implied volatility. So that'll be the first half of the lecture. In the second half, we'll talk about how to interpret implied volatility. So really understanding what it means and why it's important and how we actually use it in practice. And this is going to be kind of where you can see, building a trading strategy that uses implied volatility can be something that's quite profitable, and we'll learn how to interpret it and understand it. And finally, in the last part of the lecture, we'll be talking about the India VIX, which, if you haven't heard of it, is an implied volatility index of the Nifty stock market. And it's very useful, and you can use it. And as I said, this is only the first lecture in implied volatility. So in the next lecture, we'll be talking about additional concepts like the implied volatility smile and surface and so on. But that will come next lecture. Alright, let's get started. I want us to now think about the Black-Scholes formula. So let's remember what the Black-Scholes formula does. Okay, we don't need to remember the actual formula or the math behind it, but just fundamentally, what are the inputs and what is the output? So the Black-Scholes formula gives us the price of an option. Alright, so the output of the formula is the option price as a function of, this means the inputs, right? So it gives me the option price as a function of the following inputs. And the inputs are the current stock price, the strike price, the interest rate, the dividend yield, the time to expiry, and the volatility. So if we have these 6 items, okay, we can calculate the price of the option. Now in practice, we don't actually observe volatility. Alright, what do I mean by this? Well, when we've been looking at the Black-Scholes formula and the Greeks over the last 2 lectures, we were using a value for the volatility, but this is not something that we actually observe anywhere. Right? It's not like the stock price which we observe, or it's not like the strike price which we know what it is. Right? Volatility, we actually don't know what it is, and we don't observe it. But what we do observe is market prices. Right? So if you were to, for example, look at an option, you'd notice the strike price, you'd notice the stock price, you'd know the time to expiry, you also know the market price of the option. Right? So we actually do observe market prices. So what we're going to do is we can invert the Black-Scholes formula, okay, to give us the volatility as a function of the option price and other parameters. So what do we mean by this? Well, remember, the Black-Scholes formula gives us the price of the option as a function of all these parameters, one of which is volatility. In practice, we don't know what volatility is, but we do know the price of the option, right? That's traded in the market. So suppose now we want to actually solve for volatility, or we calculate volatility by using the market price of the option and the other parameters. And when we solve for volatility using market prices of options, this is called implied volatility. So implied volatility means the volatility implied by the current market price of the option. Okay? So one of the nice things about implied volatility is that it has a very clear relationship to the price of the option. Now, if you remember, in a few lectures ago, and also in the Black-Scholes lecture, we looked at what happens to the price of the option when you increase the volatility. So if you remember that simple option pricing model, when we increased the volatility, we saw that the price of the option went up, right? Because you get more payoff when the stock price goes up, say for a call, but there's no additional downside when the stock goes down. And likewise, with the Black-Scholes model, we saw that when we increased volatility, the prices of the option went up as well. So naturally, the same thing is going to hold for option prices and implied volatility. So as option prices go up, so does implied volatility, holding everything else constant. Right? So suppose the current option price is 5, and the implied volatility based on this option price is 20%. Alright? So suppose the current price of the option is 5, the implied volatility is 20%. Now if the option were to start trading at 6, say it went up, then the implied volatility would be something higher than 20%. Or the implied volatility would go up as well. So the key thing to remember here is that as option prices go up, so does implied volatility, holding everything else constant. And it's actually this feature that allows us to solve for implied volatility as a function of option prices, because we know that they have this increasing relationship to one another. Right? As one goes up, so does the other. And of course, vice versa will be true as well. Right? As option prices go down, implied volatility is also going to go down. Now this is true for both call options and put options. Right? We've seen that call options and put options have higher prices when volatility goes up. Right? We saw that when we looked at the Black-Scholes model. And the same thing is going to hold true when we're looking at implied volatility. So the implied volatility of the call and the implied volatility of the put both will go up when the call or put prices go up. Now a final point here that's I think quite important is that implied volatility can be different across option strikes and expiries. So what this means is that, let's say I'm looking at Nifty options and I look at the implied volatility of, say, a particular strike, and then I look at the implied volatility of another strike, a different strike. Well, those two numbers won't always be the same, right? So the implied volatility for one option strike is not going to be the same as the implied volatility for another strike. Now this may be a little confusing because surely, the underlying asset, the Nifty index, only has one volatility. It can't have more than two volatilities, right? And that's true. But in practice, remember that this implied volatility is coming from the Black-Scholes formula. And the Black-Scholes formula is not 100% accurate, right? It doesn't actually describe the market perfectly. If it did describe the market perfectly, the implied volatility would be the same for all options. But the fact that it's not, this tells us that the model is not quite right. And in the next lecture, I'll go into more detail about what exactly this means and how exactly we interpret that. But for now, just keep in mind that the implied volatility is going to be different across option strikes and also different across option expiries. So you might find the implied volatility for a 1-month option is different than the implied volatility of a 2-month option. And because of this difference, usually what people do, if you want to actually use the implied volatility, you'll typically look at implied volatility of at-the-money options because those are the most liquid and so on. You can take an average across different options to get a number if you like. There's kind of multiple ways of dealing with these differences, but again, that's something we'll come to a little bit later. Alright, so what I'd like to do now is actually go and take a look at, we're going to look at a Nifty option chain, and I want to show you the implied volatility for all of these options. Here is a Nifty option chain. Okay, if you just Google Nifty option chain, this I think is the first page that comes up. And we've seen this before. And here what we have is we have the option chain for Nifty options. And what I want to show you is these columns IV. So you see this column IV over here. That's, as you can see, it's implied volatility. There's one for put options, and then there's one for call options as well. So let's take a look at some of these numbers. So say we're looking at the 7700 put option. This option has an implied volatility of 16.21. So this is typically expressed as annual percentages. So this means the volatility, the implied volatility is 16.21%. That's the annualized volatility. And what we can see is that in this option chain, we have implied volatility for all the different options. And they're actually different for each option, right? So notice that, say, this option has an implied volatility of 16.21. If I were to take, say, the 7600 put, it has a slightly higher implied volatility, 16.93. If I were to take the 7500 put, it has an even higher implied volatility of 17.68. And you can actually see that how the implied volatility is kind of different for each option price, right? So that's for the put options. There's also implied volatility for the call options. And here again, you can see that these also vary across different strike prices. So say the 7700 call has an implied volatility of 13.66. The 7800 call has an implied volatility of 13.34. So there are even differences between the call implied volatility and the put implied volatility. And this is probably just to do with how it's being calculated. Each is calculated separately, and that can result in differences. In practice, when you do this may not occur, but as you can see, it is the case here. And again, if you wanted to get an actual number for the implied volatility, you may want to take an average of some of these options, right? So you can take the most liquid ones that are close to at the money, and then that might give you an estimate of what the actual implied volatility is. But what's nice about these chains is that they give you the implied volatility for all the option strikes that you're interested in. So one thing we can do is also look at different expiries. So this is the near-term option. If I go to the January option, this also has a set of implied volatilities. And here you can see the implied volatility is actually a tiny bit higher, right? If you remember, the put implied volatility for the 7700 strike was 16 point something, and for the January option it's 17.27. So here you can see the volatility is also varying not just across strikes but also across time to expiries. And again, you can see that there are implied volatility for all the listed options, both for calls and puts. And you kind of see a similar pattern. You can see the out of the money puts have sort of very high implied volatilities, and they kind of get lower down as you go here, start going up a little bit again as these become fairly in the money. This is a fairly standard pattern. You'll kind of see this with a lot of options. And if we just go back to the December one, yeah, you can kind of see how, say, implied volatility up here is about 21%, and then it kind of gradually declines to about 15%, and then starts going up again as we go further away from the money. And this is a very common pattern. This pattern is heavily observed across a lot of different options. It's often called the implied volatility smile. And you can see that you won't see it with the call options as much. So these are kind of low at around 13, though they do start going up towards the end here. Anyway, that's, like I said, we'll come to that next lecture. But certainly, you know, this is you can look up any option chain you like, and you should get implied volatilities for whatever option that you're interested in trading. The next thing we're going to do is calculate implied volatility, and we can do this in Excel. Now, one thing I wanted you to note, which is a little bit different to what we've seen so far with our calculations. So when we were calculating, for example, the price of an option based on the Black-Scholes formula, or we were calculating the Greeks, each of these we could calculate it using, there was a formula for each one of these things, right? There was a formula for the call option, there was a formula for the put option, there was a formula for delta, and so on. And then you just calculate the number based on the formula. It turns out that there is no actual formula for implied volatility, right? So we cannot take the Black-Scholes equation, solve it for volatility based on all the other parameters. Okay, that's why you'll never see an actual formula for the value of implied volatility, because there isn't one. So instead, the way we solve it is using a very sophisticated guess and check method. So how does this work? Well, we know that, for example, prices and volatility will move in the same direction, right? As price goes up, volatility goes up. So let's suppose the current option price is 5, and we want to work out the implied volatility. Now, basically what we would do is we would try different values for the volatility. So we'd say try a volatility of 20%. What option price does that give you? Now, if that gives you an option price of 4, which is below the actual price of 5, then I know I need to try a higher value of implied volatility. Then maybe I try 30%. If I try 30%, let's say the option price ends up at 6, then I know it's going to be somewhere in between. So because option prices and volatility move in the same direction, you basically need to do to find implied volatility, you actually have to try different values of volatility using the Black-Scholes formula, and basically keep doing that until you get the option price that's the current market price. Okay? So this is called guess and check. So we guess the value, we see if it works. If it doesn't work, we try another value, and so on. So obviously doing this on your own is very tedious and not recommended. But it turns out Excel does this very easily. Okay, so it uses a very sophisticated guess and check method to arrive at the solution very easily. And what we're going to do is we're going to go into Excel and see how this works. One thing to note is that it's a little bit more involved in terms of the calculation. We have to use a different Excel tool or different Excel function to be able to do this. I would also recommend that it's good to know how to do this, but typically there are also calculators online where they'll do it for you. So it's not strictly required, but I think it's still a good practice to understand where this number comes from. Alright, so let's go take a look at Excel, and then we can calculate some implied volatilities. Okay, so here we now have the similar data that we had last time. Okay, so if you remember, we initially looked at we first started by calculating the Black-Scholes formulas, so that's over here, all of this part here. And then we calculated the Greeks in the last lecture, which were these over here. And now I've added one more term, which is the implied volatility. Okay, so what we're going to do now is show you how to calculate this volatility and kind of the method that actually goes into doing this. Okay, so suppose based on the current numbers here, so say based on the current volatility of 24%, the value of the option price is 3. The value of the call price is 3. So let's suppose the market price of the option is 4, and I want to work out what is the implied volatility for a market option price of 4. Okay, so one way to do this will be to just guess different values of volatility till we get a call price of 4. Okay, so let's say, for example, I put in 30%, then I see the value is 3.68. So that's still too low. I can put in 35%, then I get 4.25. That's too high. So then let me try 33%. Okay, I'm getting closer. It's 4.03. Let's try 32%. I get 3.91. So that means it's something, let's say like 32.8 maybe. We're very close. Try 32.7. Too low. Try 32.75. Too high. So you can see this gets tedious very quickly. That's too low. We're nearly there, I think. So that's also just a little high. Almost there. Okay, that's close enough. So what did I do? I basically tried a whole bunch of values for volatility so that I got an option price of 4. Okay, so that's literally how we solve for implied volatility. Remember, there's no formula, so actually what we need to do is try different values till we get the right number. Now I just did it manually for you, but it turns out there's obviously a much easier way to do this with Excel. Okay, so here's what we're going to do. So let's go back to, so remember that we came up at 32.733%. Let's go back to where we started, which I believe was 24%, with an option price of 3. And now we want to calculate the implied volatility, again for a call option price of 4. So here is how we do that. So you'll go to this data tab, okay? And you're going to go to this what if analysis section. And we're going to use something called goal seek. So what goal seek does is that basically you want to set a particular cell. So in this case we want to set the call price to a particular value. Say I want to set the call price to 4. By changing some other cell, and what I want to change is the volatility. So I put this in here. Alright, so let's recap what exactly is going on here. So we're saying we want to set the cell. Okay, so I want to set this particular value, okay, which right now is equal to 3.008. I want to set it to equal 4. Alright, so I want this to equal 4 because say maybe 4 is the market price of the option. And I want to do this by changing the annual volatility. Right? So I want to basically keep changing this number so that this call price is equal to 4. So remember, that's exactly what we did just a minute ago when we did it manually. Alright, we kept changing that volatility in order to get that call price to equal 4. Now obviously that's a tedious method, right? Because you're just trying lots of numbers to seeing what works. And it turns out Excel can do that for you very, very quickly. Alright? So if I click OK, here's what's going to happen. It's saying goal seeking with cell B7 found a solution. Alright, so that means it was able to actually find an implied volatility that gave you a call price of 4. And no surprise, the implied volatility is 33%, which is what we found before. So they've also calculated much more accurately in terms of decimals. They've done it to many decimals. We did it to 3 decimals. But you can see it's come up with the same number, right? 32.73%, which is exactly what we calculated ourselves before. So I want to do this a few more times just so that we get kind of comfortable with this. So say for example we now want to calculate the implied volatility of a put when the put price is, let's say, equal to 5. Okay. So note before that I've added this column here, and this implied volatility is just taking this number over here. Okay, and that's the same for the call and the put. So again, I can do this what if analysis. and go to goal seek. So let's say this time I want to set the put price. So I want to set this particular cell, the put price, and I want to set it to a value, let's say 5, right? So maybe the market price of this put is 5, and I want to know what is the implied volatility based on this market price. So I set this to 5, and then I'm going to change. So by changing cell B5, which is the volatility. So again, let's recap what's going on here. I want to set cell B8. Okay, so I want to set the put price to a particular value, 5. Right, so say the put is trading at 5. So I want to set this put price equal to 5, and I want to do it by changing the implied volatility. Alright, so try lots of different implied volatilities until we get a put price of 5, and then I want to know what the implied volatility is. So once I click OK, so here we can see I was supposed to set it to 5. Excel found a solution for 4.999, so that's fine. It's not always going to be exact. And then you can see I have an implied volatility of 46%. Okay? So that's how to calculate implied volatility in Excel. So as you can see, it's a little bit more involved, but it's not too hard once you learn what to do. So just remember, you need to have this what if analysis here in order to do that. Let's just try a couple of more examples just to see how this works. So now you know, for example, when the put price is say 5, that's an implied volatility of 46%. When the call price is 5.53, that's an implied volatility of 46%. Let's try, you know, what happens when the option price is lower. So again, let's set the put price. Okay. So I want to set this put price, and say now I'm going to set the put price equal to 2. All right. So the market price of the put is now very low. And then I want to know what is the implied volatility based on this new market price of 2. So again, I'm going to be changing cell 46. Okay, so I'm going to be adjusting the volatility in order to give me the put price of 2. Click OK. Alright, so Excel found a solution. My target value was 2. It found me a solution where the current value is equal to 2. So it's able to give me a put price of 2. And the implied volatility of this is now 20%. Okay. So again, Excel found a solution. Now there may be instances where, you know, Excel has a difficult time. Sometimes a solution may not exist. So let's see an example. So suppose the current stock price is 100. Sorry, suppose the strike is 100, but the current stock price is, let's say, 105. Okay. Now we know that in this instance, the value of the call has to be at least 5, right? Because it's in the money by a number 5. So if the call price was below 5, you wouldn't actually be able to solve for an implied volatility. So suppose I tried this for the call price and say I wanted to change it to 4 by changing cell the implied volatility. What we should see is that this doesn't work. So as you can see, it's basically trying lots of different things. It's not working. So it says goal seeking may not have found a solution, and you can see that that was a major problem, right? That didn't work. And now it's gone back to what it was before. So it has to be the case that the option prices are valid option prices, right? In that case, what was going on was that the option was in the money, had an intrinsic value of 5, but I was saying find me an implied volatility where the option is worth 4. Well, the option cannot be worth 4 if it has an intrinsic value of 5. Okay, so that's why that did not work. So sometimes you may get, if you're trying this calculator, you may get situations where it doesn't work. But again, don't worry about that. That's it just means that probably something's wrong in your formula. but in general it should work for any actual option that you're interested in. So far we've seen how implied volatility works and how we can calculate it in Excel. And now I'd like to spend some time talking about how to actually interpret implied volatility. And I think the best way to do this is to think of implied volatility as a normalized option price. Okay? So one way you can think of it is that instead of quoting an option price as its actual price, you can quote option price in terms of volatility. So you can say Nifty options currently have an implied volatility of 18%. Or I could say Nifty options have a current implied volatility of 15%. And that implied volatility in some sense is like a price. It's kind of telling you how expensive or how cheap the option is. So think of it this way. When implied volatility is high, it means the option is expensive. And when implied volatility is low, it means that the option is cheap. And this occurs, of course, because of that nice relationship between option prices and implied volatility. Right? As option prices go up, implied volatility goes up. And as option prices go down, implied volatility goes down. So implied volatility is kind of a way of measuring the price of the option. And in some sense, it's actually much more useful than the option price itself. So if I told you, for example, that a particular option costs 20 rupees, now that number on its own is not very useful, right? Does that number tell you if it's expensive or cheap? No. Because in order to know that, you'd have to know, well, what is the strike? What is the underlying? What is the time to expiry? What are all these various other things in order to actually make sense of a number like 20 rupees as the price of an option? But instead, if I were to quote the price of an option as implied volatility, so if I tell you the option implied volatility is 15%, now that's a number that's actually sensible, right? That's a number that actually has some meaning to it. Right, so if you know I'm talking about the Nifty index, and I tell you that the implied volatility of a Nifty option is 15%, you can actually use that number to think about whether that's high or low. Right? Maybe you have seen that the market's been very volatile recently, so you think that option is quite cheap. Or maybe you've observed that the market has been very quiet recently, so that option is actually quite expensive. So implied volatility is actually a more meaningful number when you think of it as the way you can quote an option price. And the other thing that's also very useful is that it makes it easier to compare different options to one another. So let's say I was comparing, the implied volatilities, or rather I'm comparing the option prices of two different stocks. Okay? Now, if I told you the option price of stock A was 10 rupees, the option price of stock B is 15 rupees, which one is more expensive? Well, obviously the one that's 15 rupees has a higher number. It's 15 versus 10. But does that mean it's actually a more expensive option? Well, we don't really know. What if that option, the 10 rupee option, actually was an implied volatility of 20%, but the other one had an implied volatility of 10%. Now that's actually more meaningful, right? It actually means I can compare those two options, right? If I just have the raw option price, I can't actually compare those two options unless I know all the other details behind it. But if I had the implied volatilities of those two options, that would allow me to easily compare it. So that's, I think, one of the best ways to actually think about implied volatility. Think of it as an option price. Think of it as another way to tell you what the option price is and allow you to compare different options. Now let's turn to understanding what exactly does that number mean, right? So we can say, for example, that options with higher implied volatility are more expensive than options with lower implied volatility. But what does the actual implied volatility mean as a number in itself? So the one thing we know is that the value of an option depends on the underlying stock's volatility. Okay? So volatility is input into the Black-Scholes formula, right? And based on that volatility, you get a different option price. And the implied volatility of an option essentially is telling us if this were the volatility, if this were the true volatility, then that's what the option is worth. Okay? So the one way you can think about whether options are overpriced or underpriced is by looking at implied volatility relative to actual volatility. So remember, the higher volatility is, the more expensive the options are. So suppose implied volatility is greater than actual volatility. Okay, so suppose the implied volatility is 20%, but the actual volatility is only 15%. Now what this means is that the option is overpriced. Right? It means that the option implied volatility is higher than the actual volatility of the market. And when this occurs, it means that you can make money by writing options. Okay, so you can make money, say, by writing a straddle or a strangle or something like that. And of course, the reverse will be true as well. Options are underpriced when implied volatility is less than actual volatility. So suppose again that actual volatility is 15%, but this time implied volatility is only 10%. Then the option is underpriced. Then you can make money by buying a straddle or a strangle. So the second way that we can interpret implied volatility, remember the first way is as a normalized option price, right, as a way to compare different options. The second way is to help us determine whether an option is overpriced or underpriced. And for this, you need to actually look at the actual volatility relative to the implied volatility. Now there is one caveat with this concept, and the caveat is that actual volatility is not known in advance. Right? So when we say implied volatility and actual volatility, remember that implied volatility is telling you what is the implied volatility over the remaining life of the option. Right? So say the option expires in 1 month, the implied volatility is going to be, well, what is the volatility over the next month? Right, so I want to compare the actual volatility over the next month versus the option implied volatility. But I don't know what the actual volatility over the next month is. Right? That's actually something that's not known. So instead, what we need to do is we actually have to forecast the future volatility. Right? So remember, the option will be overpriced if the implied volatility is bigger than the actual volatility. But that actual volatility is not known ahead of time. It's going to be realized over the life of the option. Right? So over the next 30 days, we'll see what actual volatility is, but we don't know what it is beforehand. So what this means is that you actually have to forecast volatility. Right? You have to compare implied volatility to your forecast of future volatility. And there are many ways to do this, but the easiest method, and this is the method, I make use of this method and many others do as well, is to just measure the historical volatility using recent data. Right? So, for example, you may look at historical volatility over the last few weeks, or say over the last month, and then you can say, well, I expect that, next month's volatility should be similar to the previous month's, so I'm going to use that as my forecast. Right, so I might compare implied volatility to the historic volatility over the last month, and based on that, I'll make a determination of whether the option is underpriced or overpriced. And this is actually not such a bad method because it turns out that volatility is persistent. Right, this means that when volatility is high, it's likely to be high in the future. When it's low, it's likely to be low in the future as well. So using historical data to get volatility over, say, recent weeks is actually a pretty good method to forecast future volatility. But of course, it's not perfect, right? So I may say that historical volatility was, say, 10% over the last month. Option implied volatility is 15%, therefore the options are overpriced. But if over the next month actual volatility turns out to be really high, like 30%, then the option will end up underpriced, right? The option, you'll actually make money by buying options rather than selling them. So that's so when we have to forecast future volatility, we may not always be right, and that's obviously the risk inherent in trading. And one other thing that's, I think, worth pointing out here is that when you're forecasting future volatility, it's very important to take into account major news announcements that might be coming up. Okay, so for example, suppose we know that the RBI is going to make an announcement this week. All right, and the option implied volatility might be higher because this announcement is going to take place. Right, so the market expects that this announcement could have a significant impact, could move the market a lot, so implied option volatility is high. Now, if I were to measure, let's say, historical volatility over the previous few weeks, that might be lower compared to, the situation when the announcement is going to take place, right? So sometimes it may be that implied volatility is bigger than historical volatility, not because the option is overpriced, but because there's some big news event coming up. Right, so it's always important to keep these things in mind when forecasting future volatility. Right, so if there's a big news event coming up this week, then my forecast of volatility shouldn't just be the historical number. It should be something a little bit higher. Okay, and that's it's important to remember these things when you're comparing implied and historical volatility. So how about in practice? What actually happens when we look at implied volatility versus actual volatility? So in practice, implied volatility is usually higher than actual volatility. Right? So when we look at the data historically, we'll see that most of the time implied volatility is bigger than actual volatility. But that's not always the case. Sometimes actual volatility turns out to be very high, let's say during periods of crisis or periods of high uncertainty. But most of the time implied volatility is higher than actual volatility. And for this reason, we say that options are usually overpriced. Right? So we've talked a lot about overpriced options, particularly earlier in the course. And I just want to reiterate some of the things we mentioned last time. We mentioned a few lectures ago, is that options are usually overpriced, meaning that option implied volatility tends to be higher than actual volatility most of the time. And in particular, this effect is larger for index options as compared with individual stock options. Right, so index options tend to have a larger gap between implied volatility and actual volatility. With individual stock options, that gap is smaller. It's still there, so even for individual stocks, implied volatility is higher than actual volatility, but the gap is not as big. And going back to what we talked about a few lectures ago, these options are usually overpriced due to insurance demand, right? So because people buy options as insurance, right? So people, for example, buy put options on the Nifty index to insure against a fall in their portfolio. Because of this insurance demand, people tend to be willing to pay a little bit more for options than what they're actually worth. And for this reason, the options are usually overpriced, right? So because of the insurance demand, you'll typically see that implied volatility is higher than actual volatility. And when you buy options, you're insuring against a spike in volatility, right? So you're insuring against, say, a big crisis wiping out your portfolio or something like that, right? So this insurance demand leads to the overpricing, and that's why typically implied volatility will be bigger than actual volatility. Okay, but it's important to know that this is not always the case, right? Selling volatility doesn't make you money every single day or every single week. Sometimes you lose money when actual volatility turns out to be very high. All right, and this is a risk, of course, inherent in trading. And despite this risk, what we've seen, for example, with Income Alert is that you can actually make money selling volatility on a consistent basis. Okay, so that concludes this part. And in the last part of the lecture, we're going to talk about the VIX. So in the final part of this lecture, I want to talk about the India VIX. Some of you may have seen this or heard of this before. So just some background. The VIX, the original VIX, stands for Volatility Index. It's an index that measures the implied volatility of S&P 500 options. And this is the original VIX that's published today. And S&P 500 is obviously the largest US stock market. And recently, the India VIX was published, and this is an index that measures the implied volatility of Nifty options. So what this number is essentially the implied volatility that we've been talking about so far. And this implied volatility is actually published, and you can see it for Nifty options. So this is an index, okay? So it's just a number calculated from the option prices. It's not something that's directly tradable, although there are futures in certain situations. But it's just an index that is, a useful gauge of telling you what option prices are. The calculation for the India VIX is slightly more involved than the calculations we've seen today. So the first thing is that it uses a series of option prices. So remember I told you, there are different implied volatilities for each option. So the India VIX is calculated using a combination of different options. And it doesn't actually use the Black-Scholes formula, it uses a slightly different method, but it gives you pretty similar results. And it calculates a series of options, and it's measuring the implied volatility over a 30-day period, or 1 month. So this is also quite important because what this means is that it's doing something a little different to the implied volatilities what you actually observe in the market. Right. So in order, for example, to keep this a 30-day implied volatility, you may have to use multiple options to actually work this out. Right. So think about it this way. Imagine we have the near contract option that expires in 15 days, say 2 weeks, and then we have the following month option that expires in 45 days. Right, so we don't actually have an option that expires in 30 days, but let's say you took the average of the 15-day options and the 45-day options, you might get the 30-day options. Right, so it basically has to do that as well. So it's in order to ensure that it's always 30 days, it's taking options that are expiring less than 30 days from now, options expiring more than 30 days from now, and kind of combining them together to get you the 30-day implied volatility. So just note that the way this is calculated is kind of different to and a little more involved than what we've seen so far. And then how do we interpret this number? Well, remember, this is the same way you would interpret any implied volatility number. So this is the option implied expectation of volatility over the next month. Right? So it's saying based on option prices, what is the implied volatility over the next 1 month? All right, and that's what the India VIX index is telling you. Now you may sometimes hear that the VIX is referred to as the fear index. Okay? So what does it mean when the VIX is very high or the VIX is very low? If the VIX is very high, it means that the market expects a lot of volatility in the near future. And if the VIX is very low, it means the market does not expect a lot of volatility. So this has led some people to call it the fear index. Right? So when VIX is very high, volatility is very high, right? So an expected future volatility is very high. And as a result, it can tell you that people are scared and uncertain or fearful. Okay? But if the VIX is very low, it may mean that people don't expect a lot of volatility, so they're feeling quite confident, investors are feeling quite good and optimistic, and so on. So that's why you'll sometimes hear the VIX referred to as the fear index. And typically what we observe in practice is that the VIX will move in the opposite direction to the stock market. So what we'll do in a minute is we'll actually go into Excel and look at some data on the VIX. But intuitively, let's understand why this is the case. So what we see in practice is that when the market goes down, the VIX goes up. When the market goes up, the VIX tends to go down. All right. So what's happening here is that whenever the market falls, we're seeing an increase in implied volatility of the options. So the options are becoming more expensive. Whenever the market goes up, the options are becoming less expensive. So intuitively, this makes sense, right? Because when the market falls, what's typically going through investors' minds? Well, typically when the market falls, there's some fear or uncertainty that has caused that fall, right? And then this fear and uncertainty is reflected in an increase in the VIX. So because fear and uncertainty tend to go up when the market falls, volatility tends to go up as well, and then the VIX follows, right? So market falls tend to be associated with higher volatility, more expensive option prices. Now when market rises, we may have the opposite effect, right? When the market goes up, people are feeling more confident, and they're, don't expect future volatility to be very high, and so the VIX goes down. So that's why you tend to see this inverse relationship between the VIX and the stock market. So this is not a perfect relationship. There are some times when they'll both move up together or both move down together. So this is just kind of an approximate relationship and what we tend to see the majority of days. Finally, there's a possibility you can trade futures contracts on the India VIX. They are available right now. Unfortunately, they are not very liquid. Last I checked, there were no trading volumes at all, even though the contracts are available. So this allows you to actually speculate on the level of implied volatility in the future. If you think implied volatility will go up or down, you could use futures contracts on the India VIX to trade that view. So unfortunately, they're not liquid at this time. There are futures contracts on the original VIX, so the VIX that tracks the S&P 500. There are contracts on those, and those are very liquid and very commonly traded. There are even options on the VIX in that case. So I'm hopeful that in time the Indian VIX market will get more participants, get more liquid, and then there'll be some good trading opportunities with this. Personally, I've seen that trading the VIX, at least in the US case, has very high profit potential. So once liquidity comes to the Indian market, I think we can find good trading opportunities here as well. All right, now I'd like to go into Excel, and I just want to show you some data on the VIX, just so you can get an idea of what it looks like. Okay, so here in Excel, I have a plot of both the Nifty index and the India VIX. Right, so this is the implied volatility of the Nifty options. And you can look at the graph here. I've basically taken data over the last 1 year. So this is starting on 5th December 2014, and it goes all the way to 4th December 2015. So that's 1 year of data. And you can see the Nifty index starting around 8,500 a year ago. Today is trading quite a bit lower at 7,780. So the market's fallen over this time. And then in this column here we have the VIX, and this is the India VIX. This comes straight from the Nifty website. So if you were to look at India, if you just Google India VIX historical data, then you can get this. You can get this time series. It goes back further in time too. So if you ever wanted to build a trading strategy using implied volatility, if you're using Nifty options, then you can use this India VIX. You don't actually need historical options data as much if you can get this. So it's really useful in that sense. And here you can kind of see that the VIX is, this is quoted in percent per year. So this 11.95 means that the market implied volatility is 11.95% per year. So even though it's volatility over the next month, it's quoted in annual terms. Okay, so now let's look at the chart and let's take a look at the time series for the two. So on the vertical axis on the left side we have values of the Nifty index, and that's the blue line. On the right side we have the values of the VIX, and that is the sort of brown line. So here's what I want to show you in terms of looking at this inverse relationship. So if you start in the beginning of the time series, you'll see that, say, in this month the market goes down quite significantly. Okay, 8,500 to 8,000. At the same time, the VIX has gone up from about just over about 11 or so, 11, 12, to about 16, 17. Right? So when the market's gone down here, you can see that the VIX has gone up. And then you see the market goes back up, the VIX goes down a little bit. However, there are instances where they move in the same direction. Here, for example, the market's going up, but the VIX is also going up as well. So the relationship is not always opposite, but most of the time it tends to be. So here, for example, at this point, you see the market going up, the VIX is staying low. Market goes down from here on out, and the VIX starts going up as well. Likewise, here's, I think, the clearest example of it. Here you can see the market falls a pretty large amount in a small space of time. Right, so remember we had a lot of market volatility in August. That's this big drop in the market here, and then there's a big spike in the VIX when that occurs. Right, the VIX goes all the way up to, see, 2685, and kind of getting close to 2930. Right, when the market falls. And the market falls quite dramatically, right, from 8500 to close to 7500. So there's a pretty large drop in the market, and then a pretty large spike in the VIX. And then you can see that as the market kind of recovered, the VIX started coming back down as well. Okay, so I think this is a kind of nice illustration. It sort of shows you what, how the VIX and the Nifty index move. They typically move in opposite directions, but not always. And the effects are strongest when you see a large crash. All right, so especially this example here, when you see a large crash in the market, you then tend to see a big increase in the VIX as well. So you can take a look at the spreadsheet in more detail. It'll be available for download. You can also, download more historical data if you want to see what the VIX and the Nifty looked like previously as well. So that now brings us to the conclusion of this lecture. So in this lecture, we have done a few things. This lecture has been about implied volatility. So we started by looking at understanding what implied volatility is. So inverting the Black-Scholes formula and kind of being able to actually use market prices to come out with an option implied volatility. Right? So we talked about how implied volatility is not observable, but market prices are. So we can actually invert the Black-Scholes formula using market prices to give us the implied volatility. And then we looked at how to calculate it in Excel, and in particular how you kind of have to use this Excel goal seek function, right? That basically just tries different values till it gets the right number, but it does it very quickly. Next, we talked about interpreting implied volatility. So we talked about how you can think of implied volatility as a normalized option price, and as a way to compare different options, and as a way to tell you whether options are relatively cheap or expensive. And in particular, this is done by looking at comparing implied volatility versus actual volatility. Right? So when implied volatility is higher than actual volatility, it tells you that options are relatively expensive. And when implied volatility is below actual volatility, it tells you that options are relatively cheap. And of course, in practice, as we said, typically implied volatility is above actual volatility most of the time, but not always. And finally, just now we looked at the India VIX, and we talked about what the index is, how it works, and kind of we showed a graph of how it looks relative to the underlying Nifty index. So in next lecture, we will continue our discussion on implied volatility. So this time I'm going to go into a little bit more detail about how to understand implied volatility across different strike prices and across different maturities. So we're going to talk about something called the volatility smile. We'll talk about something called the volatility skew, and these concepts are quite important, and they kind of help you understand, again, what market participants expect, how options are priced, and ultimately how you can use this to build trading strategies. Okay, so so that'll be next lecture. So thank you very much for listening, and we'll see you next time.